I'm Matt Bishar with NAREITREIT.com here at the Wynn Las Vegas for REITWorld 2015, NAREIT's annual convention for all things REIT. Joining me for this CEO Spotlight is David Neithercut, President and CEO of Equity Residential, as well as the 2015 NAREIT Chair. David, thanks so much for joining us.
My pleasure. Thanks for having me this morning.
Now, as I mentioned, you just finished your year as NAREIT Chair. What do you see as the biggest challenges and opportunities now for the industry going into 2016?
Well, first, let me say what a privilege it has been during 2015 to work with Steve and the team. We're extremely lucky in the REIT space to have such a great team, and it was a pleasure to work so closely with them. And there are opportunities and there are challenges. The opportunities are just how large the industry has grown, the recognition we're now getting, the fact that starting this upcoming summer in 2016, the GICS classification of real estate is going to be a great thing for the space, and 90% of the listed securities in that segment will be REITs. So it's just a great time to be a REIT and a great time to be in the public real estate space. The challenges are just continuing to get that word out and continuing to attract more capital and make more people aware of the benefits of investing in public real estate through the companies that have the REIT structure, as well as you can't pick up the paper without reading about tax reform, and that's just something I know that Steve and Tony and the team are very focused on, and something that will continue to be a major focus going forward. But it's a great time to be in the public real estate space, and the team at NAREIT is just doing a fantastic job on our behalf.
Now, turning to Equity Residential, your company made some news recently with the major asset sale to Starwood Capital. Can you talk a little bit about the decision behind selling those assets and sort of what you're seeing in the market that led to that decision?
Well, as people who have been following Equity Residential for a while know that we have slowly been exiting kind of more secondary commodity-like markets and focusing our capital in the high-barrier coastal markets. And through that process, we had looked at South Florida and Denver as not long-term markets for us, but they were good apartment markets, and so they were a low priority. We had exited Texas markets and Atlanta and Phoenix, and markets that we wanted to get out first, and eventually we'd come down to addressing our interest in Denver and South Florida. And we're at a point today where there's a lot of capital looking for real estate investments. It's difficult to find good opportunities for us to redeploy that capital in our core markets just because pricing has gotten fairly rich and yields are down. And as we looked at the capital available in the space, and we thought with private equity firms, we thought there might be a very strong bid to buy these assets for us, and recognizing these assets from us in those markets, and recognizing the challenge of trying to redeploy what would be $5.4 billion of capital. We just thought the right execution, the best capital allocation decision on behalf of our shareholders would to do a special dividend. So that transaction will close in the first half of next year, at which time we expect to pay a special dividend to our shareholders of between $9 and $11 a share. And I'm happy to say that I've got nothing but positive feedback here in Las Vegas over the last several days.
Now, you mentioned asset prices are rich. Does that mean that you're still expecting to be a net seller in 2016?
Well, we've announced publicly, Matt, we're selling $6 billion of assets in 2016, so it'd be very difficult to not be a net seller. And I'm not so sure. Prices are sort of rich, but relative to the values that we could realize and when we monetize the assets we're selling, relative to the reinvestment opportunities, we thought the best use of that capital was just simply to return it to the shareholders. And I'm happy to say that that's after having delivered on those assets a plus 11%, almost 15-year unleveraged IRR. So it was a great investment. Our shareholders have done very well on it, but we just think at this point the right thing to do would be to give that capital back. And again, it's going to be very difficult for anyone to be a net buyer when you're selling $6 billion worth of property.
And what does all that mean for the development side of the business?
Well, the same thing for development. We have had a fairly active development pipeline and have done extraordinarily well in that product, which we started in 2012, 2013, kind of coming out of the recession. Today, land prices are up, construction costs are up, development yields are down, and we're just being more cautious looking at the development side and are buying less land than what we are putting into development. So while we've had elevated levels of development starts for us in sort of 14 and 15, we'll see that come down in 16 and 17.
Great. David, thank you so much for joining us.
It's very much my pleasure, Matt. Thank you.
For more from REITWorld 2015, be sure to visit REIT.com.